I'd like to go ahead and welcome everybody to the December. The year has flown, town hall meeting. Our next to the last one, we will have one that week before Christmas, but that will be the last one that we'll have this year. I want to thank everybody for joining us on these calls. It's a great way for us to communicate to you all. And the funnest thing that we've had doing these events, we don't get together and say Mel's going to talk about X, Will's going to talk about Y, and Steve's going to talk about Z. We just kind of go with what each one of us wants to talk to you all about. Gives it that opportunity to break it down. We've only had a few incidents where we might talk about the same thing, but that doesn't usually happen. And I'm going to allow Will to kick us off here tonight. Will, if you're ready to go, unmute and have fun.
Thank you so much, Steve. Welcome to almost the last town hall we're going to have this year. So I just want to share with all of you that yesterday was my first time to do a seminar. I was with Mel. We did a great 27 people. It was intimidating, but after that, we had some fun. So we talk a lot of about Social Security. So that's what I am going to share today. So keep it fresh, all this information that I have been learning the past 7 months. So the big question, right? What is happening right now? Will Social Security be there? A lot of people are saying no, it's not. It may get reduced. A lot of things are happening, a lot of maybes. So right now, we have some numbers that we can share with you. Every time you come, you send a referral or a friend. This is part of our analysis, right? Social Security is a big pillar in our analysis because it is your pension, it's part of your pensions, right? And we really want to know is this going to be there. So right now, government, the funding, the trust fund of the government for pensions, they're divided in three, right? We have the OASI, call it All Age insurance, which it is Social Security, the disability insurance, and the hospital insurance, aka Medicare. So, like most of you know, whenever we start working, we contribute into these funds. So eventually, whenever you retire, it's the time for you to say, hey, I need some of this back according to how much you put all these years. So right now we're spending a lot of money. This fund, especially the Social Security, is running a little bit out of money, but there are some ways for them to be able to recover or keep it above water. So they're looking at 2034. If we keep spending after 2034, whoever is in Social Security only will get 80% of the benefits. How, according Mel, 80 cents of the dollar, right? That's no ideal because especially you have been putting a dollar all this time and you want your investment to pay you back. You don't want to get less than what you put. If we do it in 2033, the benefits will be paying 77% of the dollar. So what can they do? They can wait, right, until 2034, 2033, but then FICA, the people that are contributing into the Social Security, they have to have an increase of 4.15%. Or we can start right now and we can raise FICA and it will be at 3.44%. I will leave you with a question. Which one will you think they will do? They will do something now or they will wait until 2034. So we will see. Another things that it may change in the system. So Most of you know, whenever you work for an employer, you contribute 6.2% to Social Security. Your employer contributes, matches you 6.2, so overall is 12.4%. If you are a self-employer, you contribute 12.4% into the Social Security fund. But maybe this will need to increase 3.44%, like we were talking about before, to be able to maintain the 100% of the benefits whenever after 2034. Back in the 80s, they raised the full retirement age to 67, and now we're still looking if they're actually going to keep increasing it. Well, there's always jokes around whenever we talk about clients about, who is going to have the worst of all these? Well, Will right there. Will's not retiring in 30 years probably, so we'll see what happened with him. Well, it scares me a little bit, but I'll be okay, hopefully. Also, we have the earnings cap, right? So to be able to contribute into Social Security is an earnings cap of $168,000. So they maybe change that too. So, but remember that these change are not going to affect the people that are actually in retirement right now or near retirement. So with Social Security also comes COLA, right? Cost of living adjustment. So they add a percentage according to the consumer price index or inflation. Especially in the last 3 years, we have been seeing a lot of inflation. So we want to make sure that that Social Security supports you to be able to afford different goods at the time that you need it. So how they measure this stuff? They usually follow the consumer price index, but this one doesn't follow the actual people behavior because, for example, what they measure is like if you go to the groceries every week, right, and you buy the same thing, and probably, let's put an example, you really like beef and you buy $20 of beef every single week, but suddenly the next week that you go, your beef is not $20 anymore. Now it's 40. So consumer price index is just going to measure you buying the same beef over, even doesn't matter, comes from 20 to $40. But the actual chain CPI, the actual chain consumer price index, measures your behavior, because if you keep buying beef and suddenly increases 100% more, you're probably going to look for another cheaper option like chicken, tuna. I don't know, if you want to go vegan, probably it will be more cheaper for you. But these measurements allow us to see these changes of Social Security and looking at the cost of living and changing that to be able to for you to catch inflation. Another important thing that we know is that you can start your Social Security at 62, right? But you will not get your 100% of retirement, of full retirement age. You will get 75%. Whenever you turn 66 or 67, depends on your age, you will get your full retirement age fund. And if you want to delay it, you can also get more if you activate it at 70. This is really important because you always can go to Social Security.gov, crunch some numbers, making sure to give you the report and tells you this is the best for you, you need to activate it. But guess what? They don't know anything about you. They don't know your other income. They don't know if you have other IRAs. They don't know if probably it's bad for you to activate that Social Security and you will have tax consequences that year. That's the reason we're here. So get that analysis. We'll be able to do that for you, analyze any factor around your retirement income, especially talk about Social Security, because like I said at the beginning, it's a big pillar in your retirement. So that's all I have today. Really excited, and we will have another seminar tomorrow. I'm looking forward to that. Thank you.
Thank you very much, Will. We appreciate it, and it's good to see you. Will's kind of hit the ground running, and it's time for him to do it. So we want that. If you know anybody that predominantly speaks Spanish, you don't want them coming in and sitting down to me, because I don't understand that. Will can definitely handle those situations now, and I believe he's learned a lot in these last 7 months as we're moving forward with it. He already knew a lot in the investment side of it, but giving him a little more planning information has been very beneficial for that. So I'm going to turn the next section over to Mel.
Thank you, Steve. So here's the thing. How many of you have walked into a store or mentioned something, and then by the time you got home, there were ads on your phone about this is something along those lines? Or, and I actually looked up a insole for my shoe, and all of a sudden I got 7 different texts and emails about insoles for shoes and stuff like that. And the reason I start out with that is because of something called information bias. And it is a tendency of people to be fed by the algorithms of the internet things that match what they already think or have already said or are already thinking. So it reinforces some of the opinions you might already have. And then the other side of it is giving you opinions from a position of authority. And I found this really interesting. I pulled up a couple different things, and I'll share a couple of them with you. This is a quote from BlackRock, one of the largest bond fund managers in the entire world. And the quote is from the chief global investment officer. And it says that we are dialing up risk taking even more during 2025 because we see gung-ho for 2025 and with the changing of the market. Then I went and looked up 2025 stock situations. And here are a couple of quotes. One from Pinecrest. Will 2025 be a year of relative clarity in the global market? Yeah, that might be true. Then again, we might have this one that basically says that, yeah, we might have some positive goings in the market. This one's from Forrest, but we really think you should be extremely careful because there's a potential for great volatility and risk. Isn't that the exact opposite of each other? And exactly that. I just clicked on 2 or 3 different things and came up with the exact opposite of what might be happening in 2025. Here's our opinion. We're not planning for 2025. We're planning for 25 years. And it's an entirely different way of looking at it. We depend upon our money management systems to make day-to-day decisions because Steve and I and Will, we're not doing that. We're looking at the overall picture and the investment portfolios, a general risk analysis of where you are and where you should be and the returns that are necessary to protect your income streams and your ability to be retired comfortably without risking losing your money or all of your money, I should say. There's always the potential for some risk, but you can mitigate that risk by how you put the different types of portfolios together. And we believe that some of your money should be protected and not at risk to the market. We believe that some of it might be very aggressive. But how much goes into each category is dependent totally upon each individual we talk with. And we try not to be swayed by the soup du jour or whatever the talking heads are talking about, what's happening this minute, this day. We're not doing day trading. We're not looking at what's specifically going to happen in a minute. Now, I will say this. If you're in the target funds that we use at Market Guard, they are absolutely looking at the trends of the market and adjusting the risk of each individual portfolio. However, if you're in the static portfolio, it's buy it, hold it for a year, and then readjust it and rebalance it. 2 different strategies altogether. Now, which one should you be in? Depends on you, depends on your risk tolerance, where you're at, all the other options. It's not a straightforward, you should be doing this, or here's a formula. You need this much flour and this much sugar. Oh, wait a minute, we do that. If you haven't read Cookies in Retirement, let us know. We'll be happy to get you a copy of it. But essentially, if I have the right ingredients to make a good cookie, then I still have to put them in the right proportions, the right amount of sugar, the right amount of flour, the right amount of milk, the right number of chocolate chips, because that's our favorite. And then I have to put them in the oven and bake them. But then some people like them soft, some people like them crispy. So how long you bake it, in other words, what the temperature is. So putting together a good retirement plan is a lot like making a cookie. You got to have the right ingredients in the right proportions, cooked to the right degree. And if we can do that, for each individual client, it really does come out to give you a situation where you're not investing for this week or this month or next year. You're investing for the rest of your life, and having a portfolio that might give you the highest probability of success and being able to really enjoy your retirement without having to worry about day-to-day cash flows or what's happening in the market. So my entire presentation today is all about, we need to plan for the long term. Don't let the internet drive you crazy with opposite structures. Be careful of what you're looking at, because it might just be reinforcing what you already are afraid of or think might happen. So it can hurt on the greed and on the fear side. So stick with the professionals, if at all possible, and people that might know a little bit more about you, than have a real interest in putting a balanced platform. We want the cookies done just right. And what's our job is to try to help you do that.
Thank you very much, Mel. Yes, Cookies in Retirement, fantastic book. If you don't have one, please don't hesitate to call the office and ask. We can go ahead and send that out to you. And it was funny, I was looking at a treadmill earlier today because I want one that'll go to about 30% incline for training for 290229. And right in front of me right now on Yahoo Finance are treadmills. And that's exactly how it is. And I think Mel's interpretation of that was totally 100%. If you think something, you're going to get more of it. And we've had a few of those. We start to look at the election, and I get some people that are overexcited. We need to get as aggressive as we can possibly get. And I look at it to the point where we've had a couple very good years in the market. And the good thing about it, adjusting for drift is very important, because if you have an 80-20 portfolio and the market's up, you might not have an 80-20 anymore. You might have a 90-10. Well, if we adjust for drift, because what usually happens when markets get too high, they tend to drop, because markets aren't going to go straight up. We are going to still have 10 and 20% declines in the market. And that's where we look at it. And I think that's the gift that when Mel and I got together a long time ago, we have to be prepared for whatever happens in the market. We can't bet your retirement on the market's always doing this, because that's not a good bet. It's not going to happen. And that's what's great about the market guard portfolios. We can get as conservative as you want to be, and we can get as aggressive as you want to be. The individual stock portfolios, if you want to talk about those, give us a call. We'll show you some of the returns of those portfolios. They are more aggressive because they're 100% equities. But for some people, that's a wonderful fit, but maybe not for all of your assets, maybe for a small portion of your assets. So thanks, Mel, for kicking that one off. I'm going to go in the opposite direction. I'm going to go to taxes. Because I get a lot of, and why is the market jumped? I think a lot of the jump in the market is when you're not talking about raising corporate taxes, corporations can have bigger profits. So I think that was one of the big things that came out of the elections. I've also heard people that they've asked me the question, when do you think we'll get a new tax bill? We don't have super majorities in Congress or the House of Representatives next year. So they'll probably do the same thing that they're talking about. They probably will not be able to make the 2017 Trump tax cuts permanent. Why? Because they don't have the 60 votes in Congress to get that through and make it permanent. But I think we'll extend that time frame. So the good thing is that window for us is that window of opportunity that we call Roth conversions. Much too late to talk about that in 2024, but I believe we have, instead of a 1-year window to get that done, we're back to probably a 6 to 8 year window to look at Roth conversions for those that it would be advantageous. A lot of our clients, it's not as advantageous for them, but it's absolutely fantastic for their children when we start to look at Roth conversions. So we do it that way. So a lot of people are saying, I think a tax bill will come through in the first quarter. I don't see it that way. I think it would be a rush. I think it's going to be more towards that third or the fourth quarter. That way we put something together that makes sense for the long term instead of just one thing up front. Because I don't think it'd be advantageous to extend the Trump tax cuts and then change the whole bill 5 or 6 months later. I think that's going to take a little bit of time to get to that place. I don't think some of the current people that have been suggested to take positions within the president-elects, I don't think all of them are going to get through. Some of them are not going to make it through the confirmation process. That's still going to have to work itself out. As I always state, I'd love to see our government move more towards the middle instead of being governed by the extremes of both parties. I'm not saying one or the other, of the extremes of both parties, moving those things closer together. So I do think that the reason why we have to run up taxes is probably the most important one. The lack or less regulation, because one of the big expenses within businesses is regulation. I get to come up and bump against it quite a bit in what compliance and regulations, how they got to kind of balance those two things out. Some of the regulations that have been put on the securities industry in the last couple of years don't make a lot of sense. I don't see how they're protecting the individual, the client, or you, the investor. I don't see how they're helping them. It just adds an extra layer of burden to us to meet that regulation that I don't currently see the advantages for. And we're just one industry. And there's a lot more industries out there that have to put up with a lot more regulations than what we do. So I want to say thank you to everybody that's out there. We have our final event of the year. It's going to be quick. It might already be over, but we are taking a lot of people to see the part 1 of the movie Wicked. You know, it's one of our things that we like to do on an annual basis is invite our clients to come to a movie review. We've done Top Gun Maverick. This year we're doing Wicked. Depending on when they put it out, Wicked 2, it probably will be the movie next year. So we look for those things. And that's one of our ways to thank the people that have referred people to us, you know, because our business has continued to grow. And that's because we're doing business with friends and family. And I just want to thank everybody out there for being a part of our family. And again, happy holidays. We'll see you again on the 18th.